Greetings and welcome to the Schulte Asset Management Investor Webinar for the third quarter of this year, 2022. George Schulte, founder of Schulte Asset Management, and I are delighted to have this opportunity to talk to you about these markets and what's going on in our fund. I'm Angela Louie. I am the Head of Business Development and Investor Relations here at Schulte Asset Management. We've had wonderful interactions with our investors, and the topics that most interested you have been ways to preserve capital in this volatile time and the likelihood of a soft landing and other possible future scenarios born of geopolitical unrest and economic worries. We are sympathetic towards those with challenged portfolios that are testing risk limits and searching for a market bottom. At the same time, we are seeing compelling, attractive opportunities that we've never seen before on both the long and short sides emerge in such dislocated markets. So what does this mean for us on the day-to-day? We continue to put on risk capital to work into high quality businesses at steep discount prices, as well as shorts in companies that will be punished as the Fed raises rates to combat inflation. And you'll hear more about all of that from George Schulte. This webinar is for investors only. If you are press or media, sign off now and contact us directly at investorrelations@samco.net. Let me share our presentation with you now. This presentation is a summary of our views. The Schulte Asset Management 2022 third quarter report was just posted into our investor data room, and you would have received an email to go into the data room to download that. So please go there to read a more detailed and expanded description of our discussion here today. In the next hour, we will cover the market review for the last quarter, talk about the outlook for the rest of this year and next year. We will talk about how the tough talk from central banks, persistent fears of inflation, and concerns about growth impacted major asset classes, indices, and currencies. George will walk us through some of the big movers in the portfolio and how interest rates and inflation pressures create windows of opportunities for us in certain industries. We also want to talk directly with you, so please ask us questions. Type them into the chat box and I will read them out loud. If you'd like to ask the questions yourselves in your own voice, we'd love to hear from you. Type the word live in front of the question and I will try to unmute you. And we'll get to all of those questions at the end of the presentation. So let's begin with performance. Our fund generated a net return of negative 19.5% year to date as of September 30th. This is in the context of broad markets sell-off reestablishing themselves in August and September. The Russell 2000 was down 25.9%, S&P 500 down 24.8%, and the NASDAQ down 32.4% for the same period. Year to date, as of September 30th, the JP Morgan Investment Grade Index was down 18%, the 20-year was down 30%, the MSCI World Index down 24%, and the MSCI EM Index down 27%. Now, this is just to give you a context of what's going on all around the globe, but our portfolio has since rebounded. And in October, our fund generated an estimated net performance of positive 19.7% for the month. For the rest of this year and into the next, our view is more market uncertainty as investors struggle with the changing macro landscape. Quantitative tightening coupled with the Fed's reiterated priority to fight inflation by increasing interest rates are elevating investor anxiety. Inflation, higher interest rates, value destruction over the past couple of weeks in digital assets, and an uncertain economic future also mean that over-leveraged and overvalued companies, many of which became that way in 2021, will face harsh operating environment and their stocks will likely drop. This all sounds very ominous. So why are we so optimistic? Well, we are finding exciting investment ideas in unconventional places. We manage risk using deep fundamental research and limit our leverage, size our positions appropriately, and adhere to stop loss guidelines. Let's talk about what happened last quarter and what to expect for the rest of this year and next year. Here are some macro numbers. Real GDP growth is at 1.8%, unemployment 3.5%, inflation moderated to 8.2%, and the 10-year treasury jumped up to 4%. Okay, so what does this mean? We are at the very early stages of a contractionary monetary policy. The Fed funds policy rate climbed from around 0.1% at the end of last year to 4% on September 30th. This precipitated widespread losses in the fixed income markets. Fiscal policy remains expansionary. President Biden's infrastructure bill and the CHIPS Act will add additional growth, and the Fed's balance sheet is well over $8 trillion now. Economists anticipate a possible 2023 recession, and we forecast that the Fed will stop tightening before causing major recession. Our view is that monetary policy will likely support growth despite uncertain global outlook, and this points to our forecast of economic growth, accommodative monetary and fiscal policies, and low unemployment. Inflation will be a problem, and the year-to-date broad market returns are emblematic of this. Now let's talk about our portfolio right now and how we are positioned against this backdrop. Our long portfolio is at an average of approximately 3.1 times enterprise value to EBITDA versus the S&P 500 11.7 times. On the short side, our portfolio is at a whopping 163.7 times enterprise value to earnings. Our fund invests in distressed securities and looks for event-driven returns from investments with inherent catalysts that may be uncorrelated to the overall markets. We pay very close attention to the way inflation will impact our trades and adhere very closely to our risk guidelines. All right, people are waiting to hear from George. And George Schultze, again, is the founder and managing member of Schultze Asset Management. And he will talk about default trends, our portfolio highlights, distress trends, and some of the big mover names in our portfolio. A brief background: George chairs our investment and strategy committees. Before founding this firm, he worked at MD SAS, Fiduciary Partners, a fund of funds, Mayer Brown and Platt Law Firm, and Merrill Lynch. I'd like to remind you now that if you have any questions, please type them into the Q&A box at any time, and we will get to them at the end of the presentation. We'd love to hear your voice, so if you are willing, type the word live in front of the question, and I will unmute you to ask so that you can ask the question yourselves. Let me start by saying hi, George.
Hi, Angela. Thank you. Can you hear me?
Yes.
Great. And can you hear me now?
Yes.
Hello? Great, great. Again, thank you, ladies and gentlemen, for dialing in today and speaking with us on our third quarter webinar. You can see here on page 5 of the deck that defaults are, you're really starting to see a lot of activity in the distressed securities world. Defaults are rising. The distressed securities opportunity set is growing. As a result, we're seeing more and more opportunities for our fund. What's interesting here in this chart, we started including this chart in our quarterly letter last quarter, thanks to Kyle on our team. But you can see, because this chart comes from the Federal Reserve Bank of New York, I believe. Very interestingly, the investment grade market is starting to show some stress here. The red line here is investment grade bond market distress. And you can see that's really starting to spike, which is concerning. In fact, that might be the potential big blow-up that causes the Fed to stop raising interest rates. Just stress in the investment grade market, or it could be liquidity issues in the treasury market. We've seen other signs like that globally. For example, the UK pension crisis, and of course, this big crypto blow up and crisis that we've seen over the last few days. So generally, we're in a market, as Angela just mentioned, where monetary policy is getting much tighter. And not many people have started to talk about QT yet, quantitative tightening, when the Fed will really start to reduce the size of its balance sheet into next year. I suspect that will be a big theme in 2023 and 2024. But nevertheless, the markets are becoming much less hospitable to aggressively financed, highly levered issuers. And because of that, Moody's, you can see here in the middle of these bullet points, they're forecasting that default rates will rise to 4.4% in 2023 as their base case, or up to close to 8% by August of 2023 in their more pessimistic case, their moderately pessimistic case. So you're clearly entering a new default cycle. And as a result, high yield junk debt issuance has plummeted down 73% through October 24th, as we note here. And you're seeing, some strange things happening, like big leverage buyout loans hung on bank balance sheets. We note the Citrix one here, there are others as well. Generally, though, in conclusion, what higher rates and tighter monetary policy mean is that, not just higher borrowing costs for companies in need of liquidity, but some will ultimately face bankruptcy and distress going forward. So here you see the various distressed trends that we track, listed alphabetically. There's really a lot going on in distressed land already, from airlines to utilities, and I'll mention a few. For example, mergers and acquisitions of distressed airlines. You have this big merger pending with Spirit Airlines and JetBlue. In the automaker space, secular change is causing distress and new opportunities, for instance, with General Motors and with Stellantis. In the casino space, you've seen lots of volatility in post-distress equities like Caesars Entertainment, which was one of the largest, or was actually the largest casino bankruptcy back in the day, a few years ago. In the coal space, just a tremendous amount of change with post-distress equities. And you're seeing inflation driving prices up. So certain coal companies like Alpha Metallurgical Coal, Peabody Energy, and Arch, they're really benefiting from this higher commodity pricing environment, and therefore they're starting to pay big dividends. I mentioned crypto on the last slide. You had this big FTX bankruptcy just yesterday, and you've seen a market capitalization for the entire crypto market go from about 3 trillion to 800 billion now. So a massive destruction of wealth from the peak. And that's going to continue causing lots of change and stress in that market. In the energy space, we'll talk about Chord Energy in a few minutes, but there are lots of names there since the energy crisis from just a couple of years ago, where lots of companies restructured and reorganized. Companies like Chesapeake Energy and Whiting Petroleum and Oasis and Chord, like I just mentioned. In the financial services space, you're seeing a time now where higher net interest income is benefiting some of the large banks like Bank of America. And of course, in the government space, you still have Puerto Rico winding its way through the largest municipal bankruptcy of all time. So we'll see how that winds up just in a few more months, it looks like here. As always, there's lots of stuff going on with litigation too. We'll talk about Revlon, where there's an interesting inter-creditor dispute. But there's also lots of companies that have had exposure to mass torts, massive amounts of personal injury claims, including those with opioid exposure due to their production or distribution of opioids. Just this morning, it was announced that Walmart settled $3 billion of opioid claims, but smaller companies like Mallinckrodt, Teva, and Endo all come to mind when I think about opioid companies with restructurings. Finally, in the retail space, companies like Bed Bath & Beyond are suffering from massive surplus inventory, secular change, most importantly, also excessive leverage, and then some of these other, macro themes like inflation, as well as growing lease liabilities during an economy that's getting and facing an economy that's looking to be much worse going forward. So let's turn to our portfolio highlights, as Angela promised we would. Just a couple quick bullet points here. Year to date, we're obviously disappointed through the third quarter. Terrible, down 19.5%, but as Angela mentioned, a nice rebound in October, and we're excited about that. During the third quarter, our important win-loss ratio was 0.65%, which is okay. We'd like to do better, but that was pretty respectable during a difficult market time like this. One thing we focused on during the quarter was trimming losing positions. And so we realized nearly 6% of our long equity losses, thereby generating some tax benefits for our domestic limited partners. Ditto on the short book. In that case, we realized losses on 321% of our short book's losses in the quarter. So really cutting losing positions quickly and thereby generating capital losses, which are useful for our domestic limited partnership or partners. One thing I like to think about when we talk about cutting losses is, and there's more detail about this in our quarterly letter for those of you who have time to read it, is that we really like to refocus on those positions that are outperforming. And that helped our October performance. It's really Pareto's law, otherwise known as the 80-20 rule. And it's been proven over time that the best money managers make most of their gains from a small percentage of holdings. So the corollary to that truism is that it means that the rest of your portfolio will often generate no returns at all or losses. So the best portfolio managers, and that's what we strive to be, look to trim those losing positions very quickly and redeploy the capital to things that are working. On the post-distress stock side, there are lots of near-term catalysts which are exciting and that we're following. We're thinking of those, come up with a term for these companies now during the quarter because so many of them have this. We're starting to call them short duration equity plays. And that is companies where we have a long investment, but we expect a short return of time or a short amount of time, a short duration of time before they pay out something to shareholders, whether it's a special dividend, execute a large stock buyback, or maybe have an M&A transaction. So those near-term events, those catalysts, we think help reduce our portfolio's risk on the long side. Now, on the short side, we've been growing that book. It's up almost at 25% now. And that's really a unique trade for us and among most distressed securities managers because most managers do not focus on short selling companies headed into distress. I think for us, that's a competitive advantage. We've done it for decades. We're actually rounding up and approaching our 25th anniversary, I'm happy to say. But this short selling of companies headed into trouble, focusing on their most junior security, their stock, again, it's a real competitive advantage because most other managers can't do it because it's capacity constrained. And also, besides providing valuable hedging for our book, I think it also gets us up to speed with industries and companies well before many of our peers look at those same companies. And we'll talk about an example with that with Pacific Gas and Electric in a few minutes. Angela already mentioned the portfolio valuation statistics for our portfolio right now. Just in summary, our long book is extremely cheap at only 3.1 times EBITDA, and the shorts are extremely expensive at nearly 164 times EBITDA. So we think that gap should narrow substantially going forward, hopefully in the near term, and we'll continue generating good gains for our partners. So in our quarterly letter, as we always do, we have a list of 5 of our best performers and 5 of our worst performers. They're listed here for you: Alpha Metallurgical Coal, Chesapeake Energy, Cord, PG&E, Revlon, and on the worst performing side, Clever Leaves, Home Products, MBIA, Pan American Silver, and Unity. But let's take a few minutes and we'll go through some of these positions now. Thanks, Angela. So the first one I wanted to talk about is Revlon, where we are short the common stock. It's about a 2% portfolio weight position for us right now. During the quarter, it generated 117% IRR. And again, remember, we have 3 types of trades in our portfolio. Like I said a moment ago, we short sell the equity of companies headed into bankruptcy. During bankruptcy, we focus on buying distressed debt at pennies on the dollar. We're generally looking for the fulcrum security there, the one that's most likely to convert into equity through a plan of reorganization. And then after bankruptcy, we focus on post-distress securities, as we call them, otherwise known as post-reorg equities or simply companies that have previously restructured. And we look for value equities in that bucket. And as I said earlier, right now we're very much focused on those that generate a rapid return of cash to shareholders. Anyway, discussing Revlon for a second, and we've had this position in the portfolio in the past several years ago. We re-entered it during the third quarter as the company filed for bankruptcy, and it became very clear that shareholders would be wiped out. I think most people on the call know Revlon. They're a lipstick company. They make beauty and personal care products. They operate globally. It was founded in 1932 and has been controlled by Ron Perlman, dating back to the 1980s when he bought it through a hostile takeover, a leveraged buyout, through to June of this year when the company filed for bankruptcy. Now, in most cases, leverage is what drives companies into bankruptcy, and that was the case for Revlon as well. It made this acquisition in 2016 that really saddled it with too much debt and left it with an inflexible capital structure to deal with all the macroeconomic changes we've had lately. So when they bought Elizabeth Arden in 2016, they added about $1 billion of debt to the capital structure. So it wasn't just leverage, but also the COVID pandemic, and then more recently, global supply disruptions that finally put the nail into the coffin for Revlon. And when it filed for bankruptcy, it had just under $4 billion in liabilities subject to compromise, which was not very good versus its current run rate of EBITDA of slightly below 300 million. As a result, you've seen the debt trade down in the whole capital stack, the junior debt trading in the mid-teens, while the secured debt, depending on the tranche you're talking about, trades at between 30 and 50 cents on the dollar. Now, shorting Revlon stock is not easy. Previously, it was subject to short squeeze risk, and it has been dubbed a meme stock before due to these short squeeze rallies. But very importantly, if you have the right prime broker, you can get the right financing for this and secure a borrow. During the quarter, I'm happy to say that finally Revlon stock was delisted from the New York Stock Exchange, and as a result, I believe that takes it out of the ability for Robinhood investors to make investments in it. And as a result, this meme stock rally has gone out the window. Our cost for short selling Revlon is almost $6 a share, $5.83 a share. And it's currently trading at about $1.25. We expect 100% return from this short, minus the cost of borrowing, of course. Our target is 0. And that's because nearly every company that goes through bankruptcy in the US, shareholders get no recovery. And certainly now in this economy, that's more likely to be the case. So turning to the energy patch, Chord Energy Corp is a new name that we haven't discussed yet. This company, it's a shale producer of oil in the United States. It's about a 13.4% position for our fund, and it had a nice return during the quarter of about 25% IRR. But it was formed by the merger of Oasis Petroleum and Whiting Petroleum, and the two businesses merged in July of this year. Now, both of those companies separately and independently went through their own bankruptcy restructurings a couple of years ago. In 2020, Oasis restructured and eliminated about 1.8 billion in debt. And Whiting also eliminated, I think, billions in debt when it restructured a few years ago. It was a good combination, lots of synergies between the two. And we had positions in both Whiting and Oasis before this merger occurred. But the net effect of the merger was that prior Whiting shareholders, including our fund, received $6.25 a share in cash, plus 0.5774 shares of the newly combined and newly renamed entity called Chord Energy. So as of September, this company has a phenomenal balance sheet. They have more cash on the balance sheet than debt, and they've committed to returning great amount of cash flow. They're doing very well. EBITDA or EBITDAX this year, which adds back exploration expense, will be about 2 billion, over 2 billion for 2022. And as a result, this management team and this board is aggressively returning capital to shareholders. Think short duration equity plays. In this case, they're returning 75% of the company's adjusted free cash flow to its owners through base dividends as well as variable dividends, and also through share buybacks. Since 2021, they've returned 1.3 billion of cash to shareholders, and through September of this year, they paid $24.53 a share in dividends. The merger was accretive to both companies on multiple metrics, but combined, and lots of people don't know the name Chord Energy yet, but it's a big company. It's larger than Hess, it's larger than Marathon, Conoco, and Devon Energy, all names that most people in the energy business know. So during the quarterly call, they announced also that they will increase their dividend to $3.67 per share, payable this November. And as a result, you have almost a 19% dividend yield for CHRD shareholders. Even so, the business trades at only 2.9 times enterprise value, and it currently trades at about $164 a share. Our target is about $275, which would be another close to 70% return from here. And our cost in the fund is $58 a share right now. So exciting to see these catalysts develop with Chord. You saw M&A, special dividends, stock buybacks, all the catalysts that we actually like to see, as well as, restructured balance sheets and just a great management team too. Let's talk about PG&E, a more well-known company, a very large utility, among the largest in the US, operating in California. This is a long post-distress stock position for us. It's an 8% portfolio weight, had about a 25.3% IRR for us during the quarter. This company trades at about $14.40 a share. Our target is above 25, about $25.50 a share, which would be nearly a 78% return for us. Our cost in the fund for PG&E is about $9.70 a share, and our firm helped backstop the company's latest reorganization. Just by way of history, since we've been involved in business for nearly 25 years, it just so happens that we were also involved in the 2001 bankruptcy when PG&E previously went into bankruptcy and distress. Back then, they settled $10.2 billion in liabilities subject to compromise. We actually had a short position in the company's pre-petition stock. We did it again during the more recent bankruptcy, which was really driven by wildfires in California. When PG&E came out of bankruptcy, its second bankruptcy, or otherwise known as Chapter 22, the company eliminated $25.5 billion in total wildfire claims. And both bankruptcies were very large. The second one was one of the largest of all time, one of the top 10 bankruptcies of all time. And in that restructuring, PG&E was able to eliminate $13.5 billion, or actually they paid to wildfire claimants $13.5 billion through $6.7 billion in cash and $6.8 billion in stock. Now, the stock paid to the wildfire claimants was paid through a tort settlement trust, and those shares represented 24.1% of the company's newly restructured ownership. Interestingly, PG&E also has a very big tax asset, which will allow them to shield taxes for many, many years going forward. And when that trust sells additional shares, because on behalf of its beneficiaries, that will create even more tax benefits to PG&E. So very interesting development here for this company. It's almost like it operates in a tax haven. We'll have to pay really no taxes for many years. They just had their quarterly earnings call a couple of days ago. They're on track to achieve earnings guidance that they previously gave of between 80 cents and $1.01 a share for this year. And management is currently projecting earnings per share growth of 10% for the next couple of years and then 9% after that. Most importantly, for PG&E, they've reduced their wildfire risks by 90% already. However, they're also planning new legislation in California that will mandate undergrounding of utility lines, and that will pretty much eliminate the remaining wildfire risk for PG&E going forward. Fortunately, PG&E doesn't have to pay for that if undergrounding is mandated in California, because as a utility, it's entitled to get compensated from its customers for big capital investments like that. Now, this company trades at only 9.2 times EBITDA, which may not sound cheap, but the peers on average trade at 14 times, and it trades at 13.5 times PE. Again, might not sound too cheap, but the peers trade at 17 times. We think that discount is no longer warranted for PG&E. The bankruptcy and other risks that have brought it to its knees through the last bankruptcy, the wildfire risks, excuse me, they've really just they're almost fully dissipated now. And although the company is slightly over levered, we think the business plan is on track, and we think that this company's stock will appreciate substantially from here going forward as they continue to report results. So let me turn it back to Angela, and then we'll open it up to Q&A.
So in conclusion, we are experiencing lower and more volatile growth in the market. Again, the Russell 2000 was down 26%, S&P 500 down 25%, and the NASDAQ down 32% for that same period, year to date. Year to date, JP Morgan Investment Grade Index was down 18%. The 20-year was down 30%, and the MSCI World Index down 24%. Our fund generated a net return of down 19.5% year to date as of September, and has since rebounded in the month of October, when the fund generated an estimated net performance of up 19.7% for the month. What you've heard are examples of a portfolio that have high conviction trades, which is crucial for the health of any portfolio during times of high volatility in the markets. Our long portfolio is at an average of 3.1 times enterprise value to earnings versus the S&P 500 at 11.7. Again, short portfolios at around 163.7 times enterprise value to earnings, which is very, very telling of not just our portfolio, but also our times. Some lessons here is that it's important to be with managers who have long track records, who have weathered different cycles. While no cycles are the same, there are similar features in all cycles, including the dynamics of an illiquid market, how extreme the pendulum can swing from one end to the other, and what to do to protect the portfolio at such times. Investors benefit from having by their side managers who have experienced through many market cycles. In lower growth prospects and more volatile markets, higher inflation and rising interest rates, all of this can continue to challenge the performance of traditional stock and bond portfolios. Having an active manager with expertise in strong fundamental research and a deep understanding of both the macro and technical environment is just so important, especially today. So where are the investment opportunities now? Well, as you've heard, there are over-leveraged, overvalued companies facing a challenging environment. Stocks will likely continue to drop, and our fund looks for event-driven returns from investments with inherent catalysts that will be uncorrelated with the performance of the overall markets. Let's take some time now to answer some of your questions. I'm going to bring George back on. Hi, George.
Hi, thanks.
We're so grateful for everyone's time, and let's get straight to the question. So first question we have is, with this marketplace and this uncertainty, what are you advising people do right now?
Thanks, Angela. Yeah, so as we noted in our quarterly letter, we're really recommending clients do two things right now. One, focus more on short selling, and that's worked really well. Nearly every short sold company has outperformed this year. But having said that, lots of companies prior business plans no longer make sense in this market environment with the capital markets effectively closed. So short sales should perform well in that kind of environment. On the other hand, on the long side, we're not saying dive deeply into distressed debt yet, but there'll be more and more opportunities growing there. However, these short duration long equity plays make a lot of sense. And you can find some with excellent yields, like we talked about Chord Energy as an example. We're seeing all sorts of catalysts on the long side, things like M&A, big special dividends, big stock buybacks. And some of them are really just commodity companies that are really printing cash right now. So the short duration of return of cash to shareholders is key. And I think that helps reduce market risk for you as well. So those are the two principal things I would say. I would also say, try to hedge your portfolio for macro risks. I mean, inflation seems to be a continuing theme, and it doesn't seem like it's going anywhere. So there are ways to hedge your portfolio. We like precious metals as a hedge there. And then also, try to protect against market volatility generally through hedges.
Thank you for this. Next question. Can you comment on the Puerto Rico bond developments?
Yeah, sure. And there's actually a decent amount of info about that in our quarterly letter too, under the section about MBIA. So the island is really proceeding through to completing its various bankruptcies. And the one that's really remaining now, you had the general obligation bankruptcy completed. That was like just general government debt. You had PREPA, which is in mediation right now. You had COFINA resolved, and you have the Highway and Transportation Authority bankruptcy close to finished as well. The one big one that remains is PREPA, and it's in mediation. I suspect the judge in Puerto Rico will mandate a resolution of that sometime in the near term. Interestingly, for MBIA, that company, its exposure to distressed credits from Puerto Rico has just dropped substantially. And now as a result, it's able to explore strategic alternatives, including the potential sale of its good insurance company. So we're very optimistic actually about the outlook for that stock. It could be a double from here easily once that gets resolved. But with Puerto Rico generally, you're pretty close to the end of the island's distress. And they seem to have made it okay through the latest hurricane season as well. But it just does say something about distress when you have the largest municipal bankruptcy in the history of the planet that's just getting wound up and concluded now.
Thank you for the next question. SPAC 1 has been identified as a poor performer. What are you looking at for SPAC 2 to identify a better opportunity in this market?
Well, thanks for that. Yeah, SPAC 1 has been a poor performer so far, but don't give up on it yet. We're working hard behind the scenes, and there's a little bit more detail what we can say publicly about Clever Leaves, the SPAC 1 merger company that merged with our original SPAC. For the second one, we're focused a little bit more on more well-established businesses. And besides that, there's not much more I can talk about right now because it's a public company, and giving details about our M&A approach would be a problem. But I'm optimistic about the outlook and looking forward to hopefully having some news about that sometime in the near future.
George, it sounds like your place in the capital structure is very important to this strategy. How do you go about thinking where in the capital structure you like to buy securities?
Thanks. So I mentioned the three approaches that we have for making investments in our fund earlier. Again, that's long distressed debt, long post-reorg equity after companies restructure, and on the way in, as they get into trouble, short selling their equity. Specifically about where in the capital stack, we do a lot of fundamental research here. We have weekly portfolio meetings where the team looks at all that analysis and tries to focus on a waterfall of potential recoveries when there's a reorganization. We try to sensitize those valuations. And for a long investment, we try to focus on those, as I said earlier, the ones that are likely to become a fulcrum security, or said another way, the ones that are most likely to convert into new common stock through that restructuring process. So that's where we like to focus, on the cheapest, and most likely to convert into equity part of the capital structure. My preferred restructuring, though, is one where almost all debt gets eliminated. You saw that with some of these energy company bankruptcies, and those businesses have now just taken off like a rocket because, as the market turned, the balance sheet was just wound up having more cash than debt when the dust settled. So those businesses are the ones that I like the most on the long side. On the short side, short selling the junior part of the capital structure is, I think, a unique and competitive advantage, and I think that's the place to focus there.
The timing of every trade is pretty crucial, especially in a time like today. Even when the fundamentals are going right, how do you think about entering a trade and then growing the position?
Yeah, that's right. I think that timing is very important. I think it helps in our process to have these weekly investment committee meetings. It's a team approach. We look to get unanimous agreement for all investments. When we do start a position, we start it small and grow it over time as we get more affirmation. So it's usually 0.5 to 2% of our fund's NAV initially. And then along the way from there, we'll grow it, as I said, after we have subsequent research and additional discussions. But importantly, if something changes in the thesis, that will cause us to rapidly cut the position. Also, if it just drops from its high watermark, that will cause us to potentially rapidly reduce the position as well. Think of that Pareto's law, 80-20 rule. We try to starve the ones that are underperforming and really redeploy capital to the ones that are performing. Behind this all is sort of a view on the market, and that is that our job is to try to find market inefficiencies, but it's not going to work every time. And it's important to acknowledge that up front and to cut those losing positions quickly, because usually if they drop and start to hit your risk guidelines, things usually get worse before they get better. And that's because something new might develop that we couldn't have possibly thought of, or that we just didn't anticipate. So that's how we think about exiting positions and entering positions. One other thing, if things go really well and a position really performs, we try not to fall in love with it. So we have a rule where we try to get out when it gets to 80% of its industry fair value multiple. That's kind of our exit target.
Thank you for this next question. Considering eventual changes in Congress as well as state legislatures, what radical proposals do you think may be on the table?
A whole host of them. Fortunately, though, we're in a period of split government now, and it appears that one or both houses of Congress might be controlled by the opposite party versus the presidency and the vice presidency. So either way, like if it winds up just being the House, or if it's the House and Senate, and we'll see there's some runoff elections going on, there's some challenges to elections, but it looks like no matter what, you'll have a split government for now. And you have sort of this lame duck period between now and January, but split government is generally pretty decent for Wall Street, because it means it's, controversial measures generally don't get passed because they require the two houses, Congress plus the presidential branch to work together. And it appears that there probably won't be big changes like new tax laws or major new changes that will impact the market. I think more important for the market right now is something that's a little bit more removed from politics, but maybe not, depending on who you ask, and that is monetary policy. You've already seen interest rates move up a lot, and they'll probably keep going up. We're estimating another 2 to 3 actions, probably bringing the policy rate closer to 5%, probably by March or April next year. But then that quantitative tightening right behind it. Really think that those two factors will have more of an impact right now on future market activity than fiscal policy, which no matter what is going to be deficit spending, and probably not much new change though.
What's going on with crypto, George?
It's a lot. If you read the paper, you've probably seen these big spectacular blow-ups. So this asset class, it really became popular due to fiat currencies and central bank errors. Last year, interest rates hit a 4,000-year low, and the Fed was printing cash. So were other governments around the world. The government was literally sending checks to every US citizen during COVID, which is a very unusual thing. I mean, they really had their feet full down on the accelerator to stimulate the economy. And that's why crypto became popular. It's one of the reasons. However, today, investors are starting to realize that crypto comes with a lot of its own risks. And because of that, because of those risks, it might not really be a good hedge for inflation. And it also might not be a good form of, or a good medium of exchange. Those risks are fraud. And you've seen just an example of that just this week, a spectacular blow up with FTX and bankruptcies. Crypto platforms have imploded and coins have been stolen. You've also seen, in terms of risk, massive volatility, which makes it very difficult to replace cash as a medium for exchange. And even technological change. I mean, crypto and the system behind it is rapidly developing right now, and consumer taste can change rapidly, with technology. So we'll see how that impacts these markets going forward. Also, just regulatory change. You've seen in the past couple of months, the SEC has started to regulate coin offerings and deem them to be security offerings. That's a big new change. And also, the IRS, in terms of taxes, is now requiring taxpayers in the US to include gains and losses from crypto on their tax returns. So all these new changes, they're really risks for crypto. They make it more difficult for crypto to be what it's been sold to be, which is a hedge for inflation, as well as a potential new medium of exchange in the face of fiat currencies and rampant financial, asset or money printing. My sense is, there's a way to go with crypto. Things are probably going to get a lot worse before they get better. And we're advising clients to stay away from it for now. But there may be some opportunities that develop over the next 6 to 12 months, I think.
Thank you, everyone, for all your questions. We are at the end of our presentation, and here are some macro points I'd like to leave you with. As markets stall from rising interest rates, it is punishing US companies that have accumulated a debt mountain exceeding $10 trillion, much of it in the past decade when the Fed kept interest rates at near zero. North American companies will have to come up with at least $20 billion in the rest of this year and in 2023 to cover rising interest rates, according to a Wall Street Journal analysis using Fitch ratings data. This will drive a divide between companies who can cut debt to survive and those who can't. This also means that this extended cycle of stress and distress period will put a lot of great ideas and opportunities in our pipeline. Thank you so much for your time. We're very grateful for you, our investors and partners who've really grown with us over the years. George and I, welcome a call or a meeting to talk about any part of this presentation, talk more about the macro environment in general, or even just what we're looking at and seeing in our portfolio. We'd love to hear from you. I'm Angela Louie, this is George Schultze, and we wish you great health and a smart, successful investing for the rest of this year. Bye-bye.
Thank you.